But before we start, I just wanted to kind of frame the discussion. The container leasing space, which is where we're going to focus most of the discussion on, has certainly been under a lot of duress over the last years. So I want to frame this and talk about where it was and where it's going to, and then I'll ask the panelists to certainly help me. The last, I guess, since last 4 years have been quite a trial for them, and I think the best way to say this is that this is a very cyclical industry. I've been covering this space for probably most of my career, for about 30 years or so, and this certainly was, I think, one of the worst cycles experienced. But the good news is that we'll talk a little bit about that, how container leasing companies manage through these cycles, and how they successfully have done it again to some degree. To kind of give some idea of the cyclicality, I'm going to talk in terms of ABS issuances right now to give you some idea. So back in 2014, there were actually 10 issuances totaling about $2.8 billion. In 2015, there was 4 issuances for about $660 million. Following in 2016, there was 1 issuance for about $140 million. 2017, we started to see a rebound, and there were 8 issuances for $2.8 billion. And 2018 seems to be on that same path. We have C-Cube on the panel, Dave Dorley, and they're one of the issuers who has issued through the cycle. So I think he has an interesting perspective on it. So starting with Dave, why don't you give some idea of how C-Cube and maybe the industry in general performed through this downturn, and maybe talk a little bit about the ABS issuances and the factors that impacted your company.
Sure, thanks, Tony. Yeah, as Tony said, it was a challenging time for the container leasing sector over the last few years. It is a cyclical business. We did see, a significant rebound, particularly in about the last 10 months or so. But what really led up to that was sluggish world trade. And really, when you look at 2015, early in the year, particularly in what we call the dry sector or just standard dry box containers, there was a buildup of new inventory of equipment. Some of the lessors took a more speculative position. We thought world trade was going to be stronger than it turned out to be in 2015. And traditionally, we see through a kind of a cycle of the year, you'll see a buildup early in the year of equipment. It kind of works its way down through the year, and then you start to build up again the next cycle. What happened in 15 was the buildup of equipment came, and it sat in China. The demand wasn't there for the lease outs. We saw very sluggish trade worldwide. While we saw some pickup here in the U.S. in GDP, Europe was still fairly stagnant. There wasn't a lot of growth there. And so what that led to was a competitive market, people trying to move equipment sitting, and it led to a compression of pricing that we saw in that market. And then we were also hit with steel box prices or steel prices coming down at that same time, and that had a large impact on the cost of the new equipment. So now you could get a new box at a significantly lower price than the boxes that were sitting in inventory that were already purchased. What we saw finally in 2016 was it continued through 16. That inventory started to work down a little bit. There wasn't as much production. I think that led to the lack of issuance in the ABS market. We weren't funding that much. In 2016, C-Cube ourselves only invested about 20% of what we would normally do in a regular year. But we saw that start to come down in 16, and then that coupled with finally the Hanjin bankruptcy in September of 2016 was kind of like the perfect storm of hitting at the worst time where we already had a sluggish market, rates were down, box prices were down, and now we had the largest bankruptcy ever in container shipping. I think the positive of that is as bad as it was and how things went down, it rebounded almost as quickly on the way back up. What we saw was the Hanjin bankruptcy, the repossession of the equipment and the redeployment of the equipment, I think exceeded all our expectations. I think the vast majority of us have been able to repossess and redeploy north of 90% of the boxes that were on lease to Hanjin at the time of the bankruptcy. And then we've seen a pickup in trade growth. And really what's happened is the supply side finally came back in check. You did not have an oversupply of equipment. We saw some modest demand. We saw a little bit of a pickup for the trade going into Europe. The United States continued to be strong. And what that led to was almost a shortage of equipment. Steel prices came back up, box prices came back up, And then, the market was able to absorb that, all that equipment and bring our utilizations back up to a more healthy level. If you look at the industry today, as I sit here, we're probably at, slightly above normal at 97, 98% utilization. There continues to be more discipline around building new boxes and oversupplying the market, and that's really led to stronger yields, and better fortunes, obviously, for all the leasing community right now. So I think when you saw 2017, there was additional growth and building of inventory, but it was absorbed almost immediately because there was a shortage, and that's what led to more issuance in the ABS market. As Tony said, C-Cube sees the ABS as a critical part of our capital base. We like to match fund our life of our asset. A container is a 10 to 12 year life asset, and we like to match fund the debt as closely as we can. So we like the single A 10-year, 5-year weighted average life paper. It works well for us, and we were the one that did issue in 15 and 16, and we've issued every year since 2011. And part of that is we feel it's important to continue to get out to the market and keep our name fresh, and obviously, offer paper to the market, and not kind of come and go at that point in time.
Mm-hmm. Yeah, thanks, Dave. And I do want to follow up on the Hanjin bankruptcy a little bit, but also I want to talk a little bit about the investor interest and what's happened through those cycles. But let's start with the Hanjin. When we look at pools of the shipping lines and Kroll, and we're rating a container ABS, certainly these by nature, they're kind of monoline industries. All shipping lines are in the pools, and shipping lines tend to be weaker credit profiles than other companies. And honestly, when we would sit in front of a credit committee, we look at the nature of the businesses. And prior to the Hanjin bankruptcy, I probably would have sat in front of my chief risk officer and said, well, Hanjin's the 7th largest shipping company in the world, and it's very likely if they ran into problems, because I'm sure a lot of it wasn't unknown, but if they ran into problems, they'd be bailed out by the South Korean government. And I would stand by that, and that makes sense. That's reasonable. But guess what? That didn't happen. Hanjin filed bankruptcy, and they went into liquidation. So it was a very interesting experience. And I want to turn to Jeanette for a minute from the legal side to talk a little bit about this situation. Dave also, if he could chime in, about getting those boxes back from Hanjin, which he kind of already talked about a little bit, but the legal side of that with the bankruptcies. So maybe Jeanette?
Certainly, and you're exactly right. The Hanjin bankruptcy was a very big surprise for most of us in the industry, I think. We all knew that there were issues, but I think there was an expectation that they would work themselves out and that there would continue to be support from the Korean Development Bank. But when that proved to not be true, I think everybody in the industry got a call at the same time to say, okay, this has happened, and now we need to really dig down. And it was an interesting time to go back and look through the transaction documents for all of these deals and really see how the provisions would work out in practice, and what protections there were on the investor side and what protections there were on the issuer side. Because I think from the standpoint of the issuers, one of the biggest concerns was that they needed an amount of time to allow that repossession process to happen, to get the equipment back and to start to get that stuff back on lease, reutilize the boxes. And some documents were better than others in providing for that grace period. I know there were a couple of issuers that did have to go back to investors and their banks and ask for some waivers during that period. But for the most part, I think that there was a really good balance in the documents of provisions that were adequately protective to the investors to make sure that they were, limited on the downside risk, but also give a little bit of grace period for this to all play out. And one of the interesting things when you're in bankruptcy is it's incredibly difficult to predict because you are sort of at that point at the mercy of a court. And we spend a lot of time in these transactions thinking about how that will play out in the context of a U.S. bankruptcy. But the truth is that shipping companies are international. And the Hanjin bankruptcy is not really located in the U.S. So a lot of the things that maybe we had thought about in advance, well, let's really game in our heads, how will this play out? Will they treat this as this type of lease? Will they treat it as that type of lease? Not all of that is true if you're overseas. And I think you need to then be sensitive both to the practical considerations that are at play, getting expert help on the ground in the jurisdiction that you're in, but also then really thinking about, okay, well, what can I actually do under maritime law? And that's where it starts to get fascinating, I think, for a lot of us, because maritime law, as we all know, is its absolutely own animal. I mean, even more so than bankruptcy law, maritime law is its own thing. And so I do know that there were some cooperative situations where certain of the issuers banded together and they said, well, we're going to protect ourselves. We're not going to rely on this unfolding in court to our benefit because we really have no way to control for that. I mean, again, you're at the mercy of the court. And so what can we do? Well, in addition to the types of remedies that you can exercise if you're a secured party under the UCC, et cetera, under maritime law, you can take actions that include seizing a ship. And well, my goodness, if you are in a jurisdiction, there aren't that many of them, but if you're in a jurisdiction where you can literally seize a ship that is full of containers, well, you all of a sudden have a completely different amount of leverage than you did. And so that's the type of thing that I think the issuers needed to be very concerned about. And again, I think the industry came through and demonstrated that it could work cooperatively, that it could think creatively, and that it was very sensitive to some of these things that you only get with the benefit of experience, like, okay, well, I'm going to think about practical leverage, and I'm going to go out there and take it.
Yeah, the repossession process itself, can be difficult, obviously, and this was the first really true worldwide carrier to go into bankruptcy. In the past, it had generally been more regional carriers. So when we went into the situation, we really didn't know as an industry how this was going to play out. I think, as I said, we exceeded all our own expectations, but there was a cooperative effort. There was a cooperative effort on the repossession, on the legal side, where we banded together as an industry, where we went into locations where maybe boxes were tied up in a terminal that, some belonged to me, some belonged to my competitors. We had more leverage to go in and negotiate as a team as opposed to individuals, and we used that quite a bit. And that really helped lead to, again, a much faster recovery than we even anticipated.
Did any kind of protocols or language come out of this that is now incorporated in new financing documents?
I haven't seen provisions that specifically address this point because primarily it is a practical consideration rather than a legal consideration. It would be almost impossible to predict where you might be in a proceeding, where a debtor might be in a proceeding in bankruptcy and how you would then address it. But I think just knowing now that there is a history of the industry forming a committee, working together in this sort of joint action, is very helpful going forward, with a better sense of how it will work on the ground.
So informal protocols and rather than documentation?
Correct.
Yeah, I think one of the challenges we've had through the years when speaking with investors and rating agencies alike is, it's hard to point to history when we don't have any history. We had history in the industry of smaller defaults, again, more regional carriers, but no one truly of this size. If I want to put a positive spin on this, I do have now is we do have kind of a playbook of exactly how this was going to work out. And we saw that it worked, very, very well. And we now have some history that I can point to when I'm talking to investors as to exactly how this will work.
Yeah, from a rating agency perspective, I agree with that because up to now it's all been very anecdotal of how things would work. And looking at the Hanjin situation and how it worked out, it really does create a very good case study for a large bankruptcy. And our concern is not just getting the boxes back, because certainly that's a major concern, which was just discussed, but it's the redeployment of those boxes to continue to generate cash flow for the ABS deals that we're rating. And I think all of those situations, from the repossession to the redeployment, in talking with issuers like C-Cube and Triton and Tal and Textainer and some of the others, it all seems to have worked out, and the boxes have been successfully redeployed. So it did create a very good case study for us to look at. But now I would like to turn to the bankers.
Tony, I think there's a question.
Oh, I'm sorry.
The Hanji's Chapter 15 filing in the bankruptcy court in New Jersey help or hinder the owners or secured creditors of boxes?
I honestly don't know that it did either. I think that it was just part of the larger picture that was unfolding. I mean, there are certain protections, again, that we understand well because we're all sitting in the U.S. and these documents are governed under U.S. law and we're sort of created with the U.S. bankruptcy process in mind. But again, taking that as a package and the advantages that come with that, On the other hand, again, I think in practice with this case study, what was happening on the ground was probably far more important to the long-term success than the bankruptcy proceedings themselves.
Okay, I'd like to turn to the bankers now, because through all this issues that were surfacing in the industry over the last year, certainly investors had a lot of concerns. I know personally, sitting at Kroll, we receive a lot of investor inquiries about the transactions, what's going on and all this. But the bankers are much closer to that in the structuring of the deals and talking with investors and new issuances. So let's start with Robert. Maybe talk a little bit about the issues that investors raised and how they were addressed and how people got comfortable.
Yeah, sure. Thanks, Tony. Obviously, I think that the discussion we just had in terms of what's happened in the last few years in the container market obviously had an impact on ABS performance, ABS structures. I guess it was, a little bit of a mixed bag. Clearly when you have a bankruptcy and when you have softness in the underlying market, what you're going to have is you're going to have less cash flow coming into deals. You reduce your per diems. That means, less cash coming in. You also sell boxes. That means when you sell the box, the residual value, if that's moved downwards, you have softness and therefore less dollars coming into deals. And then obviously the other point being that when you have a bankruptcy, what's going to happen then is that those boxes are not going to be generating cash, but they are going to be generating expenses through both the costs of the repossession as well as storage costs when they come back before they get put back out on lease. So definitely those factors would have an impact on the cash flow into the structures. And on the positive side, obviously, as deals go through time, they de-lever, and so that helps, I guess, to mitigate some of what I just said. But net in the market that was experienced in 15 and 16 and into 17, I think there were definitely some challenges. So what did that mean for the deals? I guess what it meant was that there were certainly potentially, you have a scheduled principal schedule each month, and so you could see situations where deals would get extended. You could also see situations where if the deals had certain triggers in them, like EBIT ratios, etc., they could be put under pressure. And then I guess the other point could be that if you have a deal which has an eligibility test around a bankruptcy of a shipping line, that could impact the structure in the sense that those assets would no longer be eligible for the deals. Now, I think that on the positive side, the issuers who were in the market at the time, certainly did not let those deals just move forward without taking any action. There's, certainly things that, can be done to address the situation I just described. The first and obvious thing is that the structures will have triggers that would move cash away. Cash would be redirected from equity to pay down debt. And so you would see, so if there's a trigger breach, then the cash flow then moves to pay down the debt faster. So that would be one implication. If there's other things that can be done, management advances, capital contributions, assets. These are master trusts. So what happens is assets can be added into the master trusts to kind of reset the cash flows in the deal. And, in addition, you could see things such as substitution of assets that, for example, taking out the assets that were no longer eligible and replacing them with assets that were, well-performing. And then ultimately, what we also did see some of is that, over time, in the container ABS space, there is the ability to pay off transactions after a certain window of time, and certain issuers certainly, paid off their transactions, and then replaced them with new issuances which addressed a number of kind of the cash flow issues we just described. So, for example, the new issuance then, and we can talk about this if it's helpful, but then the new issuance would have potential lower LTV and certain structural benefits that would have been, which were used to address some of the learnings from the market, the softness in the market over the downturn. But I think so to conclude, the positive is that the market, the ABS market, was able to digest the issues. The deals continued to pay to investors, while there was some choppiness and challenges. There was a combination of cash redirected through cash trap mechanisms, as well as potentially capital contributions and other techniques used to support the transactions. And ultimately, the market, as is evidenced by what happened in 2017, the market bounced back very, very well. And what we see today is a transaction that came to market in the last few weeks with the tightest spread that has, quite frankly, been seen in an ABS new issue deal over the last 7 years, which I guess is indicative of the fact that the ABS market for containers continues to be very, very open to issuers, and investors continue to be very, very constructive on participating, despite the cyclicality that was experienced in 15 and 16.
That's a really good background to what's going on today, and bringing it into how the investors are looking at this. When I talk to investors and we look at a container company, and I think Robert and Dave and some of the others have picked up on some of this, you're looking really at a business, and that business is managed a certain way. And the ABS, the boxes that are included in the ABS transactions are part of the owned and managed fleet of C-Cube or whoever the issuer is, whoever the sponsor is. And, historically, most of these companies have gone through many downturns. This is the worst, but they've been through the financial crisis. They've been through 2002 was another one, and in the 90s there was another one. And these are very experienced management teams. And the management of the fleet through these cycles has been such that they're not buying boxes during that period, which I think Dave alluded to. So the cash flows that are coming in from the leases are used to pay down and deleverage the debt on their balance sheet. ABS investors, on the other hand, are in a box. So that's SPV. Doesn't always benefit from that same level of deleveraging. But I think Robert's pointed out some situations where there is active management of those boxes to shore up the cash flows of the deals. And for this reason, if it's not evident, when the ratings of these senior tranches, the most senior tranches go out, they're generally going to be in that single A category. It's rare that you'll see a AAA bonds in containers because of the tie-in to the whole servicing platform of the company itself. So I just wanted to kind of pull that together as well. I want to turn to Xavier now to maybe talk a little bit about the investors in the ABS deals and some concerns or things that came his way. And are there any new investors to the space based on what Robert said, or are these the same investors who are just comfortable through their diligence?
Thanks, Tony. Just quickly, one word back on Hanjin bankruptcy. I think this was obviously like the largest bankruptcy experienced by the sector, but it's not all bad news, because in reality what remains, the shipping company remaining are actually much stronger. And if you look at the last few years, it's not just Hanjin who's disappeared from the industry, but there's been a lot of combination of companies. You got Maersk with Hamburg Süd, CMA and APL, Hapag-Lloyd and United Arab Shipping Company. So what you can see is clearly a concentration of companies. But the good news is that those companies that are remaining and are the largest shipping lines in the world now, probably the top 10 represent 80 to 90% of the whole trade, and that's reflected in a container lessees concentration are actually in a much better position to weather any future downturn than previously. Now, regarding the investor base, I think what we saw is back in 2014, 13 and 14, which saw probably around 3 billion of issuance every year, there was a very well established recurring investor base, core investor base that were buying consistently all deals as and when they were issued across the names, typically the big names, but also smaller names. I mean, we saw in that period of time names like Beacon, like Booz, came to the market. These were very well accepted by the market as well, and priced pretty much in line with the main investors. So it's a true testament to, I think, the sector and the structure itself rather than just the servicer. However, during the downturn in 15 and 16, some of those investors have just divested from the container ABS and have shied away from it for a little while. What we could see in 2017 is a regain of interest from those investors had left the sector just because the fundamentals are much better than they were in 15 and 16. But there's also a brand new set of investors who haven't played before and who are now interested in a sector which has a proven history of weathering downturn with a little bit of yield pickup. And I think it's important to look at the yield and not just the spreads, because obviously the swap curve has increased dramatically over the last few months. And so the new issuance spreads, as of today, are pricing kind of in the same range of yield as the one priced a few months ago. So even though the spreads looks much tighter, from a yield point of view, it's pretty much in line. So I think we have now a very large investor base interested in the sector, and the fact that you have large amount of issuance also enhance the secondary trading and therefore the liquidity, which again is important for investors to be able to prove that, to prove or to act as and when they feel uncomfortable with the sector in the future, then they'll be able to exit the market. And the last point is within the investor base, there were in 14 really, and 15, 3 transactions that we did back then using the time tranching structure that allows to do a shorter tenor tranche combined with longer tenor tranches. And the short tenor tranche was for about 2 years wall, attracted also new investors into the space that couldn't play with a typical 5 years wall and were interested in the container space. So there is a wide pool of investors out there ready and interested in the sector. And I think this is going to be very important because 2017 is likely to be another big year, as you said, given where the containerized trade and GDP is going.
No, that's really helpful. And based on what you said, it's looking at, you have the large issuers, from the Textainer, Tritons, C-Cube, Seco, who are ongoing issuers. They've been securitizing for years successfully. As you said, over the last few years, there's been a number of newer entrants to the market. But based on what you said, I just want to make sure I understand it, is that as the market recovers, there will be an investor base to look at those newer type of, smaller platforms.
Yes, I think there will be, but there's also new investors. The structures are evolving over time, as Robert mentioned. I mean, most of the issuance now are using master indenture. The master indenture themselves are much more efficient than the first set of indenture, allowing much more flexibility, allowing different series to be issued out of the same trust, which basically mitigate the risk of single issuance trust having concentrated risk in the pricing of the boxes and repricing after the typical 5 years lease. So these new structures appeal to a lot of new investors, and the new covenant and terms of this new structure begins to differ, though. If you look at the new master indenture used by the different issuers, some are using DSCR, some are using ICR, some are using EB trigger. The the definition and the calculation of these are differing from structure to structure. So I think what we're going to see is some investors starting to look deeper into the actual terms of the structure to decide which one they're comfortable with and which one they're not.
Well, that's interesting, and it's an interesting perspective, and maybe Robert could have more to say on that. I mean, from our perspective, looking at the newer deals with the DSCR has been a positive, I think, overall, looking at that trigger, the cash flow trigger. So maybe, Robert, do you have any thoughts on that?
Yeah, I think that you look at the container market before the ABS market, before the downturn and post the downturn. There's obviously some key structural changes that have been introduced as a result of learnings, during the downturn. I think there's probably two key changes that we've seen in the ABS structures, maybe three, which I think I was pointing out the master trust. But I think in terms of structures, there's definitely lower leverage. So, we saw transactions in, the first iteration between 11 and 14. The LTVs to single A were probably somewhere in the context of 80 to 85. The more recent deals for, like-for-like issuers, we've seen, 75 to 80 as being kind of more of the range of where these deals have been coming. And clearly that helps, in terms of, looking at the cash flows. The other point, and I think Tony made this point about the DSCR, I think that historically the deals, relied on an EBIT ratio. Now, some deals maintain that, but also include a DSCR. Clearly, container is not isolated. There's aircraft ABS, there's rail ABS, all transportation ABS. And I think you do see a DSCR very prevalent in some of the other assets away from container. And so I think it's definitely been a move to include that in the container ABS deals as well. And that gives investors comfort that if there's cash issues with a scheduled print, then that would quickly result in cash moving to pay down the deals faster. So I think those are the two key changes, the leverage and the DSCR. I mean, there have been discussion on other changes, and investors have kicked around, with issuers, investors, and the banking community have kicked around, potentially other features of the ABS structure that could also be, put into deals. And you are seeing, I think, some deals, including, some other things that other deals don't have. As an example, Dave's here from C-Cube, and Dave's deal, provides investors with additional benefit in terms of, eligibility around lessees that go into default, whereas that's perhaps not a universal point for all structures. And the one thing that ultimately, as bankers we'd like to do, and we think it's helpful to investors, is to try to create a kind of a template that's fairly consistent between deal to deal. And I think we're moving in that direction, but you will see differences between structure to structure. I mean, so I think Xavier mentioned ICR versus DSCR, and the CAI deal that just came has an ICR test, which is interest coverage ratio, but then some of the deals that came before had a DSCR. And, as a banker, I tend to think it's better to try to create some consistency, but, each deal hopefully will create some, will iterate in a positive direction, such that over time you can create a structure that is standardized and works for investors, as well as provides the flexibility that issuers are looking for.
Yeah, thanks, Robert. And now I want to turn back to Dave and to Jeanette at the other end of the panel. Historically, container leasing companies, it's an operating lease business. Over the years, there's been a creeping amount of direct finance leases. Now, just the differentiation is one looks more like a loan. There's a purchase option at the back. The other is a lease, and they're going to return the box, and it'll get redeployed at the end of that lease. That's created certainly some legal issues and concerns as to bankruptcies and how those will be viewed in a bankruptcy. Over time, the rating agencies, investors have gotten more and more comfortable. In fact, Kroll privately rated a deal that was primarily direct finance leases. So I just want to ask both Dave and Jeanette, from the practical side, maybe Dave, and the legal side, Jeanette, how that works and why we should be comfortable with direct finance leases.
Sure. This was an argument we've had with Tony and people like him for years, where essentially, I think the convention was thinking more around U.S. GAAP as opposed to how the rest of the world treats it. And Jeanette touched on it when she talked about it. A direct finance lease to the rest of the world, essentially, a lease is a lease, and we still maintain a title and ownership of that box until the lease is fully paid off. And for many years, we were going in and trying to make that claim that we shouldn't be disadvantaged for having boxes that are on a finance lease. And the pushback came in, that we had to go look at the different jurisdictions where these leases were actually written and how it was treated there. But the problem I had was similar to the size of the Hanjin. I didn't have any history. Generally, a lot of the finance leases had never gone into default. When you look at it, it is more of a loan. It's generally like a 5 or an 8 year full payout down to $1. The customer has like an equity interest in the box, so they want to try to maintain the integrity of that lease. But in a default scenario, we held all our rights to be able to go in and get that box and repossess it, but we didn't have history. Well, now we have history because we did not see any differentiation between having to repossess a box that was on a finance lease or an operating lease. For CQ, we actually had 77,000 boxes on lease to Hanjin at the time of the bankruptcy. 44,000 of those were on a finance lease, and it was a finance lease that had almost expired. It was down to a very low net book value, and we were able to actually recoup those boxes and then go back out and sell them out into the market.
And from a legal perspective, I think it's important to remember that there are really two questions here. The first is, and you just said this, that there's a distinction between the treatment of a finance lease under GAAP versus what the criteria for being characterized as a secured loan under the law would be. And since there is a distinction, there are certainly arguments to be made that a lot of things that are characterized as finance leases would not necessarily, in fact, be considered to be finance leases if a debtor in bankruptcy went in and tried to recharacterize those leases in a bankruptcy proceeding. And again, because a bankruptcy court proceeding is always, to whatever extent and whichever side of the table you're on, fraught with some degree of uncertainty, and the fact that this is actually something that you have to make a legal argument in support of under the UCC, it's not a sure thing, and because of that, I think there are structural disincentives for debtors to go in and argue the characterization of finance leases when it is, in point of fact, a lot easier for them to just decide whether they want the equipment or not. And on that basis, the lessor will, of course, as part of any bankruptcy proceeding in the U.S., they'll go ahead and they'll file, and they'll ask the debtor to decide whether they want to assume the lease or reject the lease. And for most debtors, and certainly in this case study it played out this way, there's not an advantage to fighting that. They just decide whether they want it or they don't want it. In this case, they don't want it. And then you get the boxes back in much the same way that you would otherwise. In fact, possibly, there are some requirements for time of about 90 days for them to make that decision. And then you would know at the end of that 90-day period whether they wanted it and they were going to continue to make those payments or they don't want it, and then you would just go ahead and proceed to repossess. So I think that it is, though, just circling back to the point that we made a couple of times already, this is under the U.S. bankruptcy code. So if you're in an international proceeding, it is unlikely that this distinction will really be a material factor in that decision either. But even in the U.S., again, because of the idea that you have to fight it, I think that we structurally just would not see a lot of contest of these finance leases. There have to be a very specific set of circumstances where it's financially advantageous to the debtor to somehow go in and say, no. There's a situation where I am going to make much lower payments in respect of the depreciation of this secured party's assets than I would under the terms of the lease. And because of the pricing strategy of the leases, there's rarely a very big delta there. And so there's just not a lot of financial incentive to do that.
Great, thank you. And for all those reasons, which is why I think investors over the years have gotten more comfortable along with the rating agencies. So I think that's a pretty helpful fact. Thank you. And I just want to follow up now with Robert and Xavier, the bankers again, to talk about, away from containers a little bit, shipping. At Kroll, we receive a number of inquiries on shipping transactions, everything that are large pools of ships that look much like an aircraft ABS, if you will, down to sale leasebacks that look very much like an aircraft EETC type transaction with a single shipping line. So maybe start with Xavier. Could you talk about some of the types of transactions that you're looking at and maybe some of the difficulties and challenges in the space?
Sure. Well, the shipping, first of all, I mean, when people talk about shipping, the shipping sector, there's not really one shipping sector. There's a wide variety of different assets within the shipping sector. I mean, if you talk about container ship, obviously you got various size of vessels, and each vessel is used in a very different market. The super large 20,000 TEU are going to be used mainly on the large east-west trades, whereas the smaller vessels are now being used much more on the regional trades. So the way you look at even within the container ship is very different depending on the size of the vessel. But then you have chemical tankers, product tankers. You could have very large ore carrier, very large crude carrier, FSRU. So each of these asset class, this shipping, what we call shipping asset class, really are very, very specific to each other. Now, one common theme among all of these is that the volatility in pricing of the asset itself and of the charter rate, being a time charter or bareboat charter, has been very high over time. And therefore, it's very difficult to propose a structure and give confidence to investors to buy into the structure when you have a history of a very high volatility. And therefore, one way to mitigate that risk, as you correctly say, is as opposed to just looking on the pure valuation of the assets as a standalone basis, is to leverage on the lessee using these assets. And that's where we come to most of the effective structure that we've come up over the last few years, really, which is what we call EETC style, where you have a strong lessee with a long-term charter utilizing this vessel in the best case scenario on a bareboat charter basis, meaning all operational costs are covered by the lessees, and therefore you leverage on the lessee credit profile and cash flow to secure a note effectively. And therefore, the valuation of the assets and the asset itself is only a secondary item in the analysis, and most of the analysis and the cash flow reliance is based on the credit profile of the lessee itself. And finally, because of each of these assets have different characteristics, it's very important to tailor the structure itself, the amortization, but also the covenants and what the lessor can and cannot do to ensure that it's tailored to the specificity of the asset class, the country is going into, the use it's going to have, and also obviously making sure that the lease itself is very tight so that you're not left midway through the transaction with a lessee that returns the vessels and you have basically an asset which is probably worth 50% of what you thought it was.
Great. And Robert, do you have anything on shipping?
Well, it's obviously certainly a challenging asset for ABS. I mean, ABS, obviously, everybody around this table and a lot of guys in the industry would love to be able to put together structures that would help to refinance out some of the shipping risk that's carried on bank books. But it's, it is challenging. I mean, obviously, what the key to ABS is you take diversification and you take underlying asset values and you use that to, bankruptcy remote structures and use that to, take shipping risk, which is, single B and below and create ABS structures which are single A, right? So that arbitrage is very, very powerful, and, it's very hard to do it in a using the same methodology that we do with container, where we're relying on, observable residual values and a certain depreciation rate and being able to sort of take comfort in how those values change over time and the ability to release, et cetera. We just haven't been able to apply that effectively into the shipping space, given some of the factors that were just described by Xavier. But it's an ongoing initiative and certainly something that we would love to be able to make progress against.
Yeah, and I would just say at Kroll, we look at all these different types of structures and the assets and so forth, and we want to consider everything, and there's lots of diligence to be done in the shipping space. And we continue to try to do that and to see where we can come up with a rating solution to work with on these transactions. I would say so on shipping, we're looking at it, it's kind of a cautious move. I would say in the container space, we're very positive. And I think the reason why we're positive is because of the resilience of these companies. As I said, the way they manage through the process, through the cycles, the strong management teams, and it's proven. These are long-term securitizers, and there's been never a loss in any space in containers, and we continue to look at it very positively. So with that, in the 3 minutes remaining, I just want to open up to the floor for any questions people may have. No? Yes?
Question for David. David, do you have the ability to swap out containers at the end of the term? It's very expensive to find and deliver them.
So, yeah, within the structure, we do have substitution rates, and essentially that's exactly what we did in the Hanjin situation. The C-Cube chose to go that route where we took out the assets associated with the bankrupt entity and backfilled it with other performing leases to strengthen the cash flows and to maintain the integrity of the structure.
Any other questions? Okay, well, thank you very much. Appreciate your time. Appreciate your time. Appreciate your time.